Hello everyone, welcome back to my channel. So this video is about a topic that I wanted to discuss already for some time now, because this basically lays all the groundwork for any trader to adequately interpret the information that is released into the market, and basically how to proceed and to use it and to proceed with the trades. And so this is a topic I want to develop a little bit further so that you guys can also leverage this information to your own benefit as you go around determining what the trades you should do. And so this is about the data that is released into the market. We are going to go through mostly the key data, the most key data that is released into the market in the United States. This is about inflation, employment, Fed related releases and disclosures, also earnings releases by companies, and GDP figures, which are a little bit less important as we will see later. But basically, the purpose is to see how can we use this information and to see what are the most likely impact on the market, and then how you can leverage this information into your trades. So without further ado, let's go. And so we'll start with probably the most straightforward data to use, which is inflation data. Basically, this is very important because it represents or is closely related to one half of the Fed's mandate, which is having or maintaining an inflation rate close but below 2%. And because of that, inflation is a very big topic, and there are, as you can see, several metrics that the market ascertains or monitors how inflation is going. The CPI in its headline, in its core perspective. Core, by the way, is discounting the most volatile elements, which is food and energy, but CPI is the most standard one that usually is given more importance by the market. Also the PCE, the personal consumption expenditures. This is especially important because it's the instead of being the inflation which is all across the board through a wide range of goods and most widespread across the market, which is a consumer price index. This is a little bit more focused on what actually the consumers expend their incomes on, and so that's why this is the Fed's preferred inflation gauge. The PPI or the producer price index, even though it's a little bit less important because it's the inflation that is faced by the producer for those companies which have the ability to pass on their costs to consumers. This can be a prelude to future inflation, which is faced by the consumer. So it's also important, although not as much as the PCE and the CPI. And so when it comes to the interpretation of the information, if the CPI or if these inflation readings come unexpectedly high, and when I mean unexpectedly is relative to the analysts' expectations, if it comes higher than what was expected, the yields or the interest rates, the returns on bonds and on T-bills, so long-term and short-term debt, they tend to jump. And why is that? Because if the inflation comes higher than expected, that means that most likely interest rates will have to go up in the future so that inflation can be brought down. and so yields tend to jump, and stocks, especially the ones more sensitive to interest rates, such as the growth stocks and tech stocks, small caps as well, tend to drop. On the flip side, if the inflation comes cooler or lower than what is expected, the yields tend to go down for the same reason. So interest rates in the future are expected to become lower because of that, and also the stocks rise with the bigger focus on the growth and tech, and also the small caps. And so this is basically what we need to account for in terms of inflation. CPI and the PCE, as I mentioned, are the most important ones. That's why their effect on equity is high. Equity and also on options, because if you trade options on derivative, as is my case, if options on equities, as is my case, the importance is very high. The PPI not so much, so it has a medium effect, but still, this is what is expected in a nutshell to happen when it comes to inflation data. The next one, which is also very important, is the employment data. And why is that? Because as you can see, the Fed has a dual mandate. One half of the mandate is keeping inflation below but close to 2%, and the other half of its mandate is to secure maximum employment without sparking inflation. Now, maximum employment does not mean that all all the people or the entire labor force is employed. That would mean a 0% unemployment rate, but that is not the case, because at that level of employment, for sure, inflation would spark, and so there is a sort of there's a widely used term in the economic field, which is a non-accelerating inflation and employment rate. And so the purpose of the Fed is to keep employment as high as possible, and on the flip side, the unemployment rate as low as possible, as long as it doesn't increase inflation. And so also because the employment data affects consumer demand, because more people employed, more paychecks are being paid to consumers, and so they have more disposable income to spend on goods and services, and so it's expected as being as a leading indicator of the economic performance, because more hiring people, more expected consumer demand, and so the economy will tend to fare better, especially in the case of the US, in which consumer demand is about 2/3, between 65 and 70% of the entire GDP. So it's a very important aspect of the the US economy's performance. But to go up to the indicators, the most important one is the non-farm payrolls, which is the number of jobs created in the non-primary sector. So the agricultural, the resource extraction are the ones who are aside, and this is about only the manufacture and the services. And so, as you can see, if it comes unexpectedly higher, yields tend to rise. And why is that? Because the higher the number, the amount of hiring that is going on in the economy, the less of a need that interest rates will have to be lower in the future, and if at least they will stay stable, or they can increase in the future. So that's why yields rise. But there can be a less certain effect, or a more uncertain effect, on stocks. On one hand, they may rise if the expected demand by consumers increase, and even though that happens, it's very unlikely to increase inflation above what is the target of the Fed. Basically, if it's unlikely to increase inflation above the Fed's target, that means that interest rates are not likely to be higher in the future, and so that's good for stocks. But of course, if the job market is already showing signs of overheating, the unemployment rate is already too low, and it's below what it should be in terms of not accelerating the inflation rate, and so it may spark inflation. and if that means that the Fed may be forced to increase rates in the future, the stocks may fall. On the flip side, if the hiring is unexpectedly lower for the same reason or for the opposite reason, yields fall, stocks on their turn can also fall, because if that means that already the economy is already close to a recession, the consumer demand is very much in the doldrums, and the job market is already showing significant signs of strong deterioration, this may lead to much lower expected demand, and because of that, consumer demand, I mean, and that's why the stocks may fall. But they may rise on the flip side, because if the job market is still in good shape, the economy is humming along, the lower employment may spark a decision by the Fed to lower interest rates, and so that's why stocks can be benefiting from that development. So it always depends on the context at which this reading comes up. And as you will see later in the presentation, this is something that is very important even for interpreting other indicators, but we'll get to that. ADP is also important, not as important as non-farm payrolls, which is basically the same reading but focused just on the private sector. So public sector employment, such as the government, is not accounted for, and that's why the reasoning is the same as when it comes to the interpretation of the readings for the non-farm payrolls, but of course, because it's only the private sector, it's a smaller section of the economy, and so it's slightly less significant. Also, keeping it within the employment data, this one is a little bit trickier probably to understand, but still, the average hourly earnings. This information also comes together with the previous the non-farm payrolls and the ADP, because this is a report. This is an employment report which is released, and so the average hourly earnings have an interesting interpretation, because if it comes unexpectedly higher but slightly higher or moderately higher, stocks tend to rise, because that means that consumers have a larger disposable income, but still it's less likely to spark inflation and by extension interest rate increases by the Fed, and that's why stocks for the most part tend to rise. But if the average hourly earnings comes significantly higher, that means that are a very large increase in the salaries of consumers, that means that it's more likely to spark inflation, and so that's why yields tend to rise. I did not say nothing about the yields when the reading is moderately higher, because yields tend not to react as much about it when that happens. But if it comes significantly higher, the expectations on interest rates tend to increase, tend to expect increases in the interest rates, so yields tend to rise, and because of that, stocks will fall, because there's a higher chance that will spark inflation, and so the Fed needs to take action. And on the flip side, that the same thing happens to unexpectedly lower AHE. All right, stocks tend to fall when it comes moderately lower, because that means that even though that it's not that likely that they may trigger a lower interest rates, but if it comes significantly lower, that means that there may be some deterioration in the job market. There may be companies may be struggling to appropriately pay their employees, and so they may have difficulty hiring, And so in order to lower their costs and to support the economy in that manner, the Fed tends to be expected to lower interest rates if it becomes significantly lower. Now, for the next one, or the next ones, these are also relatively important, but not as much as the farm payrolls again. The jobless claims, both initial and continuing, but most of the focus is on the initials, meaning the number of people that just became unemployed and are requesting jobless claims for the first time. If they come unexpectedly higher, so more people are asking for unemployment benefits for the first time, the impact on yields is very straightforward. So more people unemployed, the expectations of interest rates in the future will be lower, but stocks may rise, and may rise because if inflation is cooling, that allows for interest rate cuts in the future, or stocks may fall if inflation is already high enough, and so you have the worst of both worlds, because the unemployment is increasing, but because inflation is still high, you cannot cut interest rates because you have to keep a balance between the two mandates by the Fed, and so this situation is the worst of both worlds, and that prevents any action from the Fed. So that's why stocks may fall. If it comes unexpectedly lower, the impact on yields is also straightforward. Yields tend to rise, but stocks may rise if that means that companies are continuing to keeping their employers because they see that the prospects for future demand will continue to be strong. But on the flip side, if still the job market was already resilient enough to begin with, and because of that, even though more people are getting hired, it's not necessary to do any more interest rate cuts, the stocks may fall. There's a little bit of probably there it can happen that there may be some detachment between the growth and tech stocks, which may fall in this case, and the industrial companies, the companies in the industry sector, such as the ones which are quoted in the Dow 30. These may keep themselves stable or may even rise a bit. So that when this happens, there can be some of the detachment between the growth and tech stocks and the stocks in a more real economy sectors. And finally, the last piece is the JOLTS, which basically tells you the job openings and the labor turnover. All right, but this is probably a little bit less important because it's based on the survey, so it's not based on really hard data. All right, it has many variables that make it less reliable because it's based on the surveys. Some people may want to fill in the surveys. Some other people may not do so, so it's a little bit less accurate. But if it comes unexpectedly hotter, so there are more job openings, the companies are experiencing more employee turnover, so the yields tend to rise because that means that the job market is very dynamic, and so that because it's very dynamic, companies are fighting for the best employees. They have to pay them more, and because the salaries tend to increase more, that may push up inflation and interest rates can go higher. And because of that, stocks may fall, especially tech and growth stocks again, because of course the impact on salaries and by extension on inflation and future interest rates. If it comes unexpectedly cooler, that means that the job market is a little bit more stagnant, less dynamic, so yields tend to fall. So because of the pressure on wages for going up is non-existent. If anything, the pressure is to wages to come down. That tends to lower inflation and interest rates may become lower in the future. And on the flip side, stocks usually rise because of that specific reason. And so that is it for employment data. We now move on to probably a little bit less important as a whole, less important economic indicators. These are just economic focused indicators. They are a bit more let's just say on the hard data, but they gauge basically how is the specific sectors in the economy are doing, but they are not as important as the other ones. So when it comes to the readings of these indicators, usually the it's only let's just put it this way: if readings come according to the consensus or very close to the consensus, usually the market reaction is basically non-existent. Only if there are large surprises, there may be some reaction, but even then, it's not that big, at least relative to the employment and inflation data. Now, the first one I want to talk about is the ISM for manufacturing and for services. The ISM, the PMI, and the ISM services for PMI. So it's basically a gauge of the health of the manufacturing service sectors. The readings are within a range. So above 50 is an expansion. Below 50, that means that a contraction of these sectors. So if it comes hotter, unexpectedly hotter, especially above 50, that means it's expanding by either by a margin which is bigger than expected. Yields tend to rise, of course, because of the possible impact on prices and inflation. Stocks may rise, and especially the ones in these sectors, because of the expected larger corporate profits, and of course, very important, inflation is already deemed to be under control, so there's no risk of interest rates increases in the future. But of course, if the expansion is already happening in a context in which inflation is right on the edge of being above the target, that means that inflation is more likely to happen in the future, and so an increase in interest rates is more likely, and that's why the stocks may fall. When it comes to an unexpectedly cooler reading, especially if it is below 50, so there is a contraction of either the manufacturing or the services, of course, yields tend to fall. This is pretty straightforward. But again, stocks may fall because expected corporate profits are coming down, all right? But if still, besides, even though there is a contraction, if the reading is still a healthy one, especially if it is cooler, but it's still around 50, stocks may rise because that means that there's less pressure on inflation, and that makes future rate cuts more likely. But of course, it always depends on the context and what is the market valuing more: the impact on inflation, or the impact on consumer demand. It depends on what the market is valuing at the moment that this information is released. When it comes to retail sales, I think this is a little bit more obvious. The same reasoning for the ISM manufacturing and the services, but again, the core retail sales, because it excludes more volatile goods like the ones in the screen: automobiles, gas, building materials, foodstuff, and related services. And it depends also, and this is something that comes together with the data, if these retail sales are driven more by prices than by volume, because these retail sales is an amount of a given amount that is sold. And so if you break down the data and you see that the impact or the change in the sales relative to the previous reading in the previous month is driven more by price changes than for volume, then of course the impact on the yields and interest rate expectation is greater, and because it also messes with expectations on interest rates, that may bring a little bit more impact on the stocks, because that also means that interest rates can go up or down. At least it's more likely that to happen. Now, continuing on from here, and again, this is a little bit less important than the previous economic indicators because it's a survey and it's not hard data, and so it depends on whoever is filling out this survey. But again, unexpectedly stronger consumer confidence has basically a straightforward impact on yields because of the expected consumer spending. But again, for the same reason, stocks may rise if inflation is under control, or may fall if the resulting inflation, because of the increased expected demand, may threatens inflation increases, and by extension interest rate increases as well. If consumer confidence is unexpectedly weaker, for the opposite reason, yields fall. Stocks may rise if there is a chance that there will be action by the Fed to lower interest rates, or stocks may fall again if it is not likely that interest rates will come down, and instead the amount of expected corporate profits is expected to be bigger, and especially in the more cyclical business, which are more likely to be more affected by changes in the consumer confidence. So it always comes down to the relationship between the inflation, the expected demand, and what is impact that will have on the interest rate decisions by the Fed. When it comes to the Michigan expectations, which is also consumer confidence reading, it's very similar, but if it's unexpectedly higher, and because this is the Michigan is not on the is on the expectations for inflation, not for the consumer confidence, because it's focused on inflation, is very much straightforward. It comes expectedly higher, the likelihood of interest rates increases in the future are higher, and so stocks tend to fall. But if it comes unexpectedly lower, the opposite happens. Yields tend to fall and stocks will rise. But again, it's a low to medium impact on equity, and by extension on equity options. So usually these do not have much of an impact on a market. And this is it for the leading economic indicators. Or no, actually there is one more. So I think this is the last one, the durable goods orders. Durable goods, again, it's very much related to the consumer confidence, because the durable goods are the ones that require a bigger expenditure because they are more expensive. So it's more related to how the customer or the consumer is feeling in terms of its future prospects. And so if you get unexpectedly stronger orders, again, the same reasoning, yields rise, stocks may rise, especially the ones in the consumer discretionary and cyclical stocks, such as automobiles, electrical appliances, and that sort of items. And if inflation is deemed under control, interest rates should not rise despite these stronger orders, so stocks tend to rise, but can also fall if we are more on the edge in terms of inflation, and if inflation has a more of an impulse because of these stronger orders, we may see interest rate increases in the future, and that's why stocks may also fall. The opposite reasoning happens with unexpectedly weaker orders. Yields fall, stocks may rise if it opens the door for future interest rate cuts, but stocks may also fall if inflation is deemed as already in a good place or slightly higher, and because of that, because nothing can be done in terms of interest rate cuts to tame inflation, or about because of the inflation, stocks may still fall because of lower corporate profits. Um, yes, and now these are also not that important. The national accounts data, again, advanced second and final GDP. The advance is the most important one because it is the first reading of the GDP. The other ones is just they just confirm what the advance showed up, and so only if there are revisions, especially if those are significant, um, these can also move the market. But the advance is the most important reading, and again, I don't need to explain this much further. The same reasoning applies as the leading economic indicators when it comes to unexpectedly stronger or unexpectedly weaker readings. The reasoning is the same, and so I don't need to repeat myself any further. This is basically the way you should interpret this information for your trades. But again, the impact is not that big, and usually it is only the estimate, the advance estimate that moves the market, if it happens to move. Industrial production and capacity utilization, again, the same or a very similar reasoning, but with even a lower effect. All right. For those who are probably less familiar with economic concepts, I will touch upon a bit on the reasoning behind this indicator and why this happens this way. Basically, how much slack and tightness exists on the goods producing side. And I mentioned here the example of labor in Russia. So if you have a very dynamic job market, and you are running at production capacity, and you have no more room to increase your production any further, that means that in order for you to stop the amount of demand that's coming through your door as a manufacturer, the only way is to increase the prices. Because if your job market is overheated, if you are operating at maximum industrial capacity, and you cannot produce any more or at a higher rate because you don't have the resources to do it, the only way you can compensate for that excess demand is to raise the prices. And as a result of that, that's exactly what we see in Russia, with higher rates of inflation, high increases in wages as well, in order to compensate on the side of the prices going up, is to stem or to lower the amount of demand that is coming towards companies. And because there is a shortage of labor, the only way that you can compensate to get the best workers and to get some workers and to keep some workers at your company, you have to increase the wages so that they will be enticed or incentivized to stay working for you. And so this is probably the best example I can give to you. But of course, again, the effect on equity is low, and in the case of the United States especially, usually there is always excess capacity or some underutilized capacity, and so this is unlikely to be any sort of market mover in that regard. Now, I think this one we come back to the very important ones. So far, I've been doing this, but in a decreasing level of importance fashion. But now we come back to a very, very high importance kind of information because it's Fed related information. Topping the chart, let's just say that this is the Fed interest rate decision, all right? And especially when it comes to surprise decisions, all right? Basically, in accounting for all of this information that we spoke about before, the Fed makes a decision every 1.5 months, so 8 times per year. But it's not only about the rate decision itself, is the guidance that the Fed chairman gives in the press conference, because it sets the stage for expectations of the future interest rates, all right? And so overall, if the interest rate decision and especially the guidance are unexpectedly hawkish, and I mean hawkish is on the side of increasing interest rates, all right? They expect that they may have to increase interest rates in the future. I think this is a pretty much clear-cut interpretation. Yields will rise, all right? So the short term rise the most. The ones at the 1 year, 2 year interest rates will rise the most relative to the 10-year or 20-year rates, and so that's why the yield curve often tends to flatten, and the stocks of course will fall, and especially the growth and tech stocks and also the small caps, because they are more dependent on the funding that is influenced by interest rates. And so yeah, this is very much what happens. Discretionary and cyclical may fall a bit less, because that if that happens, because if this hawkish stance is happening, is because the economy is running very strongly. These ones, the consumer, discretionary, and the cyclical businesses may be less affected by the drop in stock prices. On the other hand, if overall the decision and especially the guidance are dovish, and so there is the chance that interest rates will be lower in the future, the opposite tends to happen. Yields will fall. Short-term yields, 1 year, 2 year, fall the most, and the yield curve tend to steepen because the 10-year and 20-year move less, right? And the stocks will tend to rise, especially the growth and tech stocks, and also the small caps. Now the dot plot is important, not as important, but still very important. I mean, not as important, of course, as the decision or the guidance, because at the end, that's a decision which is made in a consensus by the Fed members. But the dot plot basically tells what each of the FOMC participants or the members believe it will be the Fed funds for the coming years and in the long term. And so the median dot is the perceived Fed's forecast. And it's, of course, it's a forecast, it's not an actual decision or a commitment to follow that direction, but it's a forecast. Forecasts can fail, many times they fail, but again, it's a hint of what is rather likely or expected to happen. And again, we can base ourselves in being unexpectedly higher, the dots unexpectedly higher, or hawkish stance, and unexpectedly lower, or dovish stance, and it happens the same things as the decision or the guidance, which I mentioned already. But of course, the decision and the guidance are the most important thing. Also, but not as important, the Beige book, the Fed's Beige book, which is basically a picture of how businesses and communities are going along across the Fed's 12 districts. Now, again, it's less clear-cut, but if there are hotter conditions, so a very, very strong business growth, that the job market is very tight, there are rising wages and prices. Usually, of course, with yields, it's straightforward, they tend to rise. Stocks may fall, especially the growth tech stocks, because of the higher likelihood of increasing interest rates. But again, a detachment can happen. The consumer discretionary and the cyclical may fall less if the economy is running very well and inflation is not that significant to begin with. The opposite happens when with cooler conditions. The yields tend to fall and stocks may rise, especially the growth in tech stocks because of the expectation of lower interest rates. But if there is a large risk of recession, the topic of the economy is gains a bigger importance than the interest rate topic, and so stocks may fall because of that. Now, there is some Fedspeak which is random, but it occurs almost every week. Some Fed member has a moment in which he speaks to the public, and so it usually comes up questions about what is going to be the interest rate decision in the next meeting, and because of that, sometimes investors take a hint or interpret that disclosures as a hint about the future decisions of interest rates. Again, there is not much to say about this. If they signal possible interest rate cuts, yields fall and stocks will rise. And speeches signaling interest rate hikes, the yields tend to rise and stocks tend to fall. Now, of course, if it's a Fed chairman speaking, there is a little bit more of an impact, but if it's other Fed member, the impact tends to be a little bit lower, and it depends also on the level of uncertainty about the future path of interest rates. These speeches tend to have more of an impact on the market the higher the uncertainty are the expectations of the investors. Now, putting this all together, and this is to wrap up the set of indicators that we spoke about. In terms of importance, again, tier 1, the most important, the critical ones: inflation, employment, and the press conference about the FOMC meetings, in which they talk about the decision and the guidance for future interest rates. Again, also tier 1, company earnings. We didn't speak about that before, but because it's rather obvious what happens when earnings are released. But when it comes to company earnings, the most important ones, the Magnificent Seven tech firms, the other tech companies, when it comes to the also tier 1 company earnings and guidance, not only the earnings are important, but the guidance when it comes to expected future business performance. The Magnificent Seven, especially Nvidia, which is the biggest of the seven, are the ones that move the market, and you can see that there's a lot of expectation when among investors when these earnings are about to be released. Also, Oracle, Broadcom, which are also companies outside the Magnificent Seven, but still they move the market pretty much, especially because they are in the artificial intelligence field. And so they have the capacity to move the market, and any surprise basically has a ripple effect across the market. So these have a very high importance. Not as important, economic data, which is tier 2, the ISM PMIs, the retail sales, the jobless claims, which is also employment related, but it's not as important as the non-farm payrolls and employment and the average hourly earnings. Also, the JOLTS and the PPI. tier 2 company earnings, the consumer staples, which are the big ones, Walmart, Costco, uh, financial entities, the big ones, large conglomerates, energy giants. So these are also important, but not as important as the Magnificent Seven and the other tech companies. So that's why it makes sense to not place them in the tier two, in the tier one, but having them in a tier two. And then in the tier three, other economic data, GDP, durable goods, and consumer sentiment and industrial production. Uh, Probably the only one that may move the market a bit is the GDP, the advanced reading. The other ones normally do not move the market, and so that's why they are in the tier three. Now, having said that, we proceed to the next part of the presentation, which is basically what kind of moves or option strategy can we use to profit from the moves in the market. If we are talking about large moves and we don't expect to have, we don't know what direction it will come about, we can use, and keep in mind, I'm using a pattern of going from the most expensive to the cheapest. All right, so this is the order or the ranked of the strategies. All right, and so these, because these are for large moves, these are mostly for tier 1 data and some tier 2 earnings. All right, and basically the largest potential profit and the highest probability of profit is a long straddle, but also because it is um, it is more expensive, it also balances out basically, and this is a long straddle. So yeah, that's why it's the most expensive, but it has the highest probability of profit because the stock does not need to move much to go into the profit. Right, now the next one, the long strangle, is the same thing as a straddle, but you don't use at the money puts and strikes, puts and calls. You use out of the money ones, so the price is here and you select puts and strikes out of the money. It's less expensive, but you need a larger move to profit. So that is the trade-off basically. Now the next one, it's less, it's very similar to the straddle, but the thing is that you have the straddle over here, but then you have the profit capped. So you sell puts and sell calls, which are further out of the money, because this helps to lower the cost of the strategy, but to compensate for that lesser price, your profit, your potential profit is capped, right? Now, similar to the strangle, you have the iron condor, which is, you can see there is the long strangle in here, but then because you sold the put, further out of the money put and the further out of the money call, your profits are capped, but your cost is less, right? Now, if you know, or if you expect that the large move will happen to the upside, the most expensive one and the simplest one is basically a long call. All right, you usually you tend to use the out of the money call option. So this is the way it works. If it happens, you can profit by this large move. If you are not willing to pay such a high price for the call, you can use a bull call spread, in which you have the call, but then you buy the call, but then you sell a short. You sell a call with a higher strike price. Your profit is capped, but still you can calibrate the strike to profit potentially more or less, and depending on that, you pay more or less premium, netting a net premium. If you expect, on the other hand, that the price will go down, the most expensive one and the most profitable one is the long put, which is basically you buy a put, all right, and so you are protected against the downside of the downward moving of the stock. If you want to reduce the cost of the put, but of course your profit is capped, you after you buy the put, you sell another put with a further lower strike price. Now, the wheel is not a debit strategy. It's not. It's a strategy that it does not have. You don't pay. You always receive premiums, but that is because that is the purpose of the wheel. If you see that a large move will be coming, you are more conservative in your short puts. When you have the cash, you sell the puts, so you sell at a lower strike. You get lower premium, but you are also less likely to be assigned, so you are less likely to be forced to buy the stock. And if it happens, you bought it at a lower cost, so then it's easier for you to recoup your cost basis, your acquisition price, when the stock recovers. If you are in a position in which you already have the stock, you sell the call, but then you select a higher strike price. And why is that? Because even though you collect less premium, if you end up being assigned and a large move happens, you are more likely to have a capital gain instead of breaking even, or a lower capital gain, if you are forced to sell, meaning if you are assigned. So on the other hand, if you expect a small move, again, these are strategies that in which you don't pay, you usually receive cash, because the purpose of profiting from a small move is to sell basically is to sell options, all right, because you keep the premium, the move is small, you are not assigned, and you keep the premium for yourself. So this is basically the mirror of the large moves. You have the short straddle, which is basically the opposite of the long straddle, all right. You sell at the money call and put, all right. Again, short strangle, it is the reverse of the long strangle. You sell out of the money put, out of the money call. Iron butterfly is the same as a short straddle, but again, because you want to not to be exposed to unlimited losses, you buy a call and then you buy a put, which are further out of the money. But because you bought them, you get less premium, but basically you are more protected and you are no longer exposed to unlimited losses. Same thing with the iron condor. You have a short straddle in here, but then you buy a further out of the money call and a further out of the money put to protect yourself. But this is, of course, if you are not sure of the direction the move will be, but the move will be small. If you expect a small upward move, again, the best way is to sell a put, right? Sell a put. The price, if we will finish around here, you will not be assigned, you keep the premium, and that's it. Again, if you want to protect against your downward exposure, you buy a put with a lower strike price, and then you are basically protected. Keep in mind, this is the same as a bull call spread, because it's the same thing, but you are doing basically the same strategy with a put. I think I can show this here. See, bull call spread is the same thing, but you are doing the same strategy with puts instead of calls. Now, if you expect a short move, a short downward move, again, if you have the stock, and why I say if you have the stock, because you can do this without stock, but then you have to use leverage, and this is something that I never do. But yeah, whenever you sell short calls, in the straddles, in the strangles, in the butterflies, and the condors, you always have to held stock to sell the call side. Otherwise, you are selling the calls naked, and so you have a much bigger risk that you can be potentially wiped out. But and so this is something that I never recommend. So I always say that whenever you have the short to sell a call, make sure you have the stock. Short call, nothing to nothing very very strange. This is just a call option which is sold, and then if you want to be protected against the downside, you can then buy a call with a higher strike price. So this is basically the same as your let's see, your bear put spread here. So it's the same thing. It's the same strategy, but then we are doing this with calls and not with puts. And lastly, for the wheel, which is a very specific strategy. If you expect a small move, of course, you're going to sell a put a bit more aggressively with a higher strike, because then you maximize the premium you collected, and because you expect a small move, you are still not very likely to be forced to buy the shares. And if you already have stock, you sell a call, but you sell at a lower strike, never below the stock cost basis. You don't want to lock yourself into having a loss, a potential loss, but you put at a lower strike so that you collect more premium, but still, because you expect a small move, you are not likely to be assigned anyway, so you maximize the return of your strategy. Now, with all these strategies, I think the question that anyone should ask at this point, having seen all this, is if it's should you always trade whenever an information or a data is about to be released. It depends, and it depends on whether the implied volatility, which is reflected on the option premiums, higher implied volatility, the premiums are inflated. If and if there is not a volatility event coming up, or an important data release coming up, the premiums will be lower. And so it depends on whether this implied volatility is not pricing correctly the expected intraday price move. And how do you see this expected intraday price move? You just look at what happened in the past when the same data or the same kind of data was released. And so based on this difference, and also depending on the level of confidence of his estimate of the expected intraday price move, all right? So because you as a trader, you may be more confident that the same price move as in the past will happen, or something different will happen. And so you have to keep in mind that this is also a matter of judgment. It's not only about data, because implied volatility is provided by most trading platforms, but also it depends on your judgment of how far or how big will be the price move, the expected price move relative to the implied volatility. Now, how much confidence will you have? It depends on how consistent the price moves were over the past 6 to 12 months, all right, when this data was released. If there is more consistency, it's natural that you're going to have a higher level of confidence. Less consistency, lower level of confidence. And also depends on whether those past data readings were a surprise relative to the market expectations or in line with those expectations. If there have been surprises in the past months, chances are another surprise will happen, because the market is not reading the situation correctly. And so this is something that can enact a larger move. Why do I say 6 to 12 months? If you see at the bottom, the further back you go to get more pieces of data, the data is more likely to belong to a different interest rate regime, a different type of market conditions, and so you are adding more noise instead of material information or material data points. So at some point the data, you are adding more data which is irrelevant, and so that's why 6 to 12 months, you can use 10, it's usually enough. Of course, as you can see also as well, surprise readings often cause large moves that usually last longer, but inline readings may cause quick and small moves, but they tend to revert back quickly, or the market may not even move at all. Now, with this in mind, I'm going to give you an example because this is always better to help you understand. And so in this example that I'm giving to you, there's a CPI reading coming up in the next few hours, and a trader wants to profit from it by trading 0DTE options, so options which will expire on that same day, right? They expire on the day in which a trade is made. And we are going to use the Qs, the ETF, which tracks the Nasdaq 100. Let's just assume, for example, that the price of the Qs is $600 a share. And so let's just see, the trader estimates the price move expected by the market, which is this one over here, the expected intraday price move. How does is actually, I'm sorry, the estimates how much of is the implied volatility, or the volatility which is expected by the market. This is the correct one. Yeah. So, and by how does he do that? He sums the premiums of the put and the call using the same strike price, which is ATM, with the at the money strikes of the ATM calls and puts, which have the strike of 600 because the share price is 600. And so if the put and the call mid premiums, which is basically the mid price of the puts and the calls, are these ones, we sum them and we have 9.5 points. Now, if you divide this by the 600, you'll see that the market basically is expecting a move of about 1.6% on either direction, all right? And so if you consider that this is an index, this is an ETF tracking an index, and indexes by their nature have a relatively lower volatility, a 1.6 move, it's not every day that this happens. Indexes usually do not move by this much over a single day because we are trading 0DTE options, and this is a significant move. So the market is assigning a sizable probability of a surprise reading because only surprise readings enact large moves. Now, for this example, why am I using 0DTE options? You can read in the footnote below. Because option premiums reflect more of the changes in the share price, so I want to maximize the profit by getting the size of the move right. And why is that? Because the delta moves quicker, so any change in the share price causes a bigger change in the option price because of their gamma is very, very high on 0DTE options. The gamma is how much the delta changes when the share price changes, and so it's a second order effect of the delta. And so because I want the delta to be very, very sensitive to the share price, I want to use options which have a very high gamma, and there's no higher gamma than in 0DTE options. And so if the trader sets a large move and is right, the gains easily offset the loss of value because of the passage of time. 0DTE options, because they expire on the same day, the theta is very high, it loses value very quickly. But if we get the move right, because the delta will move so quick because of their high gamma, this effect, if I get it right, it will very easily offset the loss of value because of the passage of time. It will overwhelm every other effect. And so that's why 0DTE options are the best to leverage this move and to get this move, to profit from this move. And so if we look at the past 10 releases, we'll see that 3 readings were a surprise and the market moved about 2%, and then the last 7 readings we have uh, 7 readings in line with the market expectations, and the market move and the share price moved 0.3% on average. All right, and so with these conditions we have also to assess what is the chance or the probability of a surprise in the CPI reading. What can we do? We can see what are the expectations of many different analysts, see the dispersion of them. So a larger dispersion or a more dispersed distribution of forecasts. That means that the uncertainty is bigger among analysts. They cannot predict very accurately what's going to happen, and so the chances of surprise is bigger. Inflation trends and market sentiment. If inflation is trending in one way, but other data readings suggest that prices and wages are going the other way. Let's just say, for example, inflation is getting higher by the CPI readings, but you see that, for example, the employment data tells you that the most recent employment data tells you that employment is coming down and employment is going up, and durable goods order, consumer confidence, they are all coming down. And so this conflicting data means that there is more uncertainty about what's going to happen. And when it's more uncertainty, you have a higher chance of a surprise. Also, the market behavior around the two-year rate in the yield curve. Again, if traders are strongly betting in a specific outcome, all right, if the CPI comes against that, there will be for sure a strong reaction because they need to unwind the positions quickly to avoid losing money. And so if the market is betting in a particular direction, there is a higher chance that can be a large move if the interest rates, if the CPI comes in with a very surprising reading. And also, if the rate has been moving within a very, very tight range for several sessions, that means that traders are very uncertain about what's going to happen, and so they are trading in a very tight range. They don't know when it's going to go, and so if the CPI reading comes as a surprise, this range will most likely broken out, and a large move will happen. And so these are also important pieces of information that can you assess whether a large move is likely or not so likely. And also the market reaction to previous CPI readings, whether the previous CPI readings triggered a large move, not so large move, whether they were more in line or less in line, more surprise, less surprise. This and how the markets reacted, because in the absence of better information, a similar reaction can happen if the data comes likewise it did before on a surprise level or on inline level. And so these are all pieces of information that the trader can use to increase its level of confidence in the move. And so based on the analysis of all these factors, the trader should be able to follow this line of reasoning. So asking himself, what is the most likely magnitude of the move? If it's a large move, the trader then should ask himself, do I expect the price to move more or less than the move reflected in the option premium or by the implied volatility? If the trader expects the price move to be more than what is reflected in the option premiums, that means that it goes in this direction, and so the strategy will cost less than the gain that he will have if the move is according to his expectations. And so he should trade the debit strategies, or the ones that are good for large moves, suitable for large moves, because the price, even though he's going to pay for to set up the strategy, the likely gain, if he gets it right, will exceed the cost of the strategy. But if he sees that, all right, the move will be large, but the price move, the expected price move by me, is less than the expected the implied volatility reflected in the options. So the market expects an even larger move than I do, basically. That means that the likely gain, even if I get it right, the likely gain will not be enough to offset the cost of the strategy. Because if the market expects a much larger move, the options will be too expensive. And so either you don't trade, or if you really want to trade, you trade credit strategies, the ones that profit with small moves, but you have to do it conservatively to avoid excessive risk exposure. So you select the strikes very conservatively with a very low delta, or rather, which means that they have a very high probability of expiring worthless, these options expiring worthless, and so you keep the premium. But of course, you have to be conservative, and the upside will be little because you are being very conservative in these trades. And so on the flip side, if I expect a small move, now I have to see, all right, do I expect the small move to be larger or to be smaller than the one reflected in the option premiums or by the implied volatility? And so what that means is that if I expect the price move to be smaller than the one that the market expects, that means that the option premiums are too rich, are higher than they should be, because the market expects a larger move than I do. And so it makes sense to trade credit strategies, because the premiums reflect a larger move, still small, but a larger move than I do. And so I can trade credit strategies with the expectation that, all right, we are not going to be assigned, we can profit from this small move because the market expects a slightly larger move than I do, so the premiums are larger than they should be, and so it pays off to trade credit strategies to profit from this small move. But if on the flip side, if I expect that the price move will be larger than the one expected by the market expects a even smaller move than I do, that means that the premiums are very, very, very low. And so, because of that, it does not work to trade credit strategies because the premiums are so small and do not compensate for the size of the move, even though it's small. And so you should not trade. Or if we trade, because the options are so cheap, we can we can trade debit strategies. But because the premiums are so small, it does not pay to go as aggressive with long strangles or long straddles because they are too expensive. No, we use something which is more lower cost, such as debit spreads, bull call spreads or bull put spreads, very with a very low upside potential, so that they are less expensive. Or you can use the long butterflies, the long condors, because the trades, the premiums are so low that the possibility of profit is not that much. And so in order for you not to be with a loss, because you want the strategies to go into the profit zone for you, it's more likely if you don't spend too much money on these. Again, it can also happen if the price is not expected to move at all. You can simply not trade, or you can simply trade credit strategies to collect premiums, because if the price does not move, you do the premiums, you collect the premiums, these credit strategies expire, and that's it. You don't have anything else to do. They expire worthless. You keep the premiums, and that's pretty much it. Now, to wrap this up, and these are some last minute pointers for you guys. So some strategies are suitable for which are suitable for small moves, which are the credit strategies, can be used to profit from large moves, and vice versa. It's all about you selecting the strikes accordingly and making sure that your the probability that you will have a profit is high enough so that you can be in the green. And of course, you have to consider to what extent the market is pricing the expected move. Now, a quick note about the wheel. The wheel's only objective is to collect premiums. Can be used any market conditions, but of course, sometimes it's not the most suitable strategy. For example, if you expect large moves, is not by any means the best strategy, but you can still apply it with proper selection of strike prices, meaning with very, very conservative selection of strike prices. Now, most often, it's not about the number, the actual reading, CPI or the employment, whatever. It's more about the gap between the surprise and the consensus, and also the current economic context. Whether the investors are more concerned about inflation or are more concerned about the economic conditions, such as employment, the state of the economy, the risk of recession, all of these factors need to be considered when it comes to make your understanding or establish a probability of the probability and the size of a move. Now, the bigger the deviation from expectations, both from consensus and from private readings, obviously the bigger the move. Again, as I mentioned many times when I was explaining the indicators, the rates are a transmission mechanisms, all right? And so if the releases moves short-term yields, equities usually follow, all right? This is pretty much a no-brainer, all right? And this is something that you need to keep in mind, because as you saw, interest rates and or yields are very straightforward in terms of their reaction to specific readings. Equities less so, but you see that the yields are mostly a mechanism through which then the impact is reflected on equities, especially in the growth and tech stocks. Now, as I mentioned, ongoing regime matters. Inflation and Fed obsessed regimes, the CPI and the PCE entice the biggest moves, and when the concerns is more about the economy, the possibility of recession, employment data, activity data such as industrial and services and GDPs entice the biggest moves. And that's pretty much it. I want to make sure that you guys understood this to the best extent possible. I'm available on LinkedIn and in the comment section to answer any questions that you may have, guys. I want to make sure that you can use this blueprint for your trades to the best way possible, and so that is why it's extremely important that we keep the communication available and an open communication channel available, so that we can then discuss and making sure that we are on the same footing and to ensure that you guys are as successful as possible in your trades. And so that's it. Feel free also to like the video and subscribe to the channel, and I'll see you in the next one.